We're continuing our series on analyzing the individual sectors going into and now through 2025. And I think even though they're not two of our most exciting sectors as far as the ones that we're analyzing, I think it's really important to talk about the industrials and materials sectors.
Yeah, agreed. They kind of go hand in hand, which is why we're lumping them together. Obviously, there's unique portions of each, but the industrial sector as a whole is kind of all lumped together to begin with. We're going to go through kind of the major categories, but there are a lot of very unique businesses in there. And kind of to your point about maybe not the most exciting is there's a lot of interesting stuff going on once you drill down, but at a surface level, materials and industrials both underperformed over the past year. And, that's not really because of economic weakness or financial issues with the industry as a whole. It's really down to these are very capital intensive segments of the economy. We're talking about big machinery, like just big investments involved in all of this, as well as interest rates being high. That very expensive machinery is very expensive to finance right now. And that hasn't been appealing to investors. Going through 2025, looking forward to rate cuts in the coming years, that story starts to change.
Yeah, I think you said it exactly. This is going to be more a story of the underlying industries within the industrials and materials. And of course, just to kind of start it off is that the reason we're lumping these together is because these big industrial projects that you're talking about, of course, almost always rely on the material sector to provide the aggregates, the inputs that go into these big capital intensive projects. And to your point about interest rates coming lower, that's going to help spur a little bit of growth within these industries. But industrials and materials are really sectors that rely on the broader economy being in a good place. I can't really think of two sectors that are more aligned with economic health as far as how the companies are going to perform more so than industrials and materials, because other sectors can typically have their own mega trends or trends happening that are unique to them. Think about in the 2000s, the dot-com bubble. Well, that wasn't really so much about the broader economy. It was about the tech sector. AI is a little bit specific to tech itself. But whenever you're talking about industrials and materials, those are two sectors that really rely on strength of the broader economy. And going into 2025, we view a pretty solid economy right now. You've got a strong job market. Companies are investing in capital intensive projects. I think we do still have the headwind of interest rates, but getting into 2025, as rates continue to drop, financing becomes a little bit easier. I think industrials and materials or companies are ones that are going to be worth analyzing. And especially when you talk about the industry level dynamics, which we're about to go into, I think there's some interesting stories there as well.
Yeah. And so just to kick us off kind of as an aside, something that's integral to all of this is just broader machinery that is in materials, talking about mining and, to farm equipment, to true beginning of production, sheet metal stamping jigs and all of the stuff that goes into, just your first initial inputs. All of that, kind of like we've mentioned, very capital intensive. It's getting more and more complex by the day. I think something that's really interesting is seeing companies, we've talked about them before on the show, Cameco, investing in automating a lot of their mining operations. They have automated mining trucks driving around, and these are huge, ginormous, many dozens of tons mining trucks that are driving around on their own because that segment is so dangerous in general that they can get people out of harm's way into safer production jobs. But that kind of leads us into these things are getting more complex and more expensive on their own just as technology progresses. I mean, we have farm tractors driving themselves and planting crops themselves, crazy stuff going on, but that makes the machinery more important or more expensive, as well as the financing now is more expensive than it has been in decades.
Right. I feel like whenever you think about machinery, heavy machinery, you think of it as kind of this legacy industry where you're talking about, bare bones, you're talking about steel, you're talking about big machines that are kind of, big and dumb, but really the advent of new technologies led to these really sophisticated mining processes, agricultural processes that require new upgraded machinery. And so I think that's an interesting dynamic. And I think, especially as we get into later in 2025, especially 26, when that financing cost comes down, you'll probably see even more investment in those new generations of machinery out in the field.
Yeah. And real quick to that point is that have been for a very long time big and dumb, like you said. And because they're so expensive, you see lathes and big, machinery like that's been around since the 70s and it's still working today because it's big, very expensive when it's built, incredibly expensive to reproduce nowadays. But kind of to that point of the advent of like more and more technology is that now it's becoming almost a necessity to replace those, not because they don't work anymore, not because we can't repair them anymore, but because of the economic gains to be had via all of this additional, AI or just, additional technology that we can put into these machines now. And so real big thing there.
Absolutely. And so I think that's fascinating. And I think throughout this conversation, you're going to see the disparity or the big differences between industries within industrials within materials, because we're going to shift from machinery to aerospace and defense. Now, this is still kind of one of your legacy industries, but it's very different in its own dynamics because defense spending is this ongoing spend. It's pretty non-cyclical, meaning it's not going to ebb and flow with the economy. The defense budget only continues to really grow. And now that we have a new conservative administration in office, it's more likely than not that defense budgets will rise rather than fall. And so you've got this kind of non-cyclical industry in aerospace and defense, and the company's been performing pretty well. I think also you have to look at the global stage when you're talking about aerospace and defense, because geopolitical tensions, while they have started to cool somewhat, I mean, we're kind of at relative highs as far as geopolitical tension across the world and wars going on. So of course, that's going to lend itself to more spending in defense, the defense industry.
Yeah, indeed. And just noting on there that we're talking about defense, aerospace and defense, because we're going to talk about commercial airfare later, which has its own unique set of things. But, it's kind of interesting how much, some overlap, but a lot of individual dynamics within some companies that make, jets for civilians and the military, think Boeing or something, for example. So, lots of intricacies to all of this.
Yeah, I think before we can continue on, I think it's interesting hearing, we were just talking about the revolutionizing of heavy machinery. Well, more and more people are talking about revolutionizing the way that we look at aerospace and defense, on the defense side, because you're talking about, while these companies aren't in the industrial sector, but you're talking about more cybersecurity. I know that recently the CEO of Palantir is talking about really revolutionizing the way we think about defense, because it's becoming more autonomous, it's becoming less manned, it's becoming more digital. And so talking about taking what's kind of a heavy machinery legacy kind of industrial project and bringing it up to speed with the 21st century and with this age of AI and autonomous is going to be really interesting to see how those companies have to spend. And the thing is, governments are going to have to spend to keep up with that. So that's going to fuel that industry going forward.
No, it really is. And to your point, great segue there. Thank you, Victor. Into AI as a broader concept. It's something we've talked about on previous podcasts, so we don't want to go too in depth here. But, these AI projects, you have a ton of funding behind, ton of investment, and that spans all the way from the most base of materials to the most high tech, chips and everything. But you're talking about, millions of pounds of aggregates, just rock aggregate in a new data center. You're talking about the electrical components that need to, take place in the data center, from your HVAC, from your power supply. A lot of this can't, once you get more technical, can be included in technology, but a lot of industrial processes are required in the construction of the building, in, like I mentioned, HVAC, and your bare bones, just getting a foundation where you can go implement that technology.
Right. And I think along with that, you've got, the HVAC, but also the energy supply products like generators is a huge piece of that as well. And the AI infrastructure you're talking about with, increased AI and data center spend, using some more of those base materials, whether it's aggregates, like you say, or copper, certainly something that's coming into the conversation more as we get into the greater electrification of broader industries. This is really, I think, is becoming an overarching theme in this conversation, is that we're talking about these somewhat legacy industries that are becoming, revolutionized via technology. They're becoming more autonomous. It's like robotics, for example, that we've talked about on prior podcasts. It's becoming more sophisticated, more data intensive, you're leaning more into that electrification, the AI, autonomous realm. And so I think it's interesting seeing the way that these industries are shifting. And so getting into that, you mentioned aggregates, but I think base metals, and this is where we're really getting into the materials sector a little bit more, is something that you have to talk about when you're talking about industrial, especially the materials sectors, steel being a huge portion of that. And we'll talk about copper in a minute as well. But I think the outlook for base metals is not quite as bullish going into 2025. We've seen that industry, especially if we're going to talk about something like steel, for example, really suffered and has suffered because the base metals in general, but especially the steel sector, is so reliant on China, or has been so reliant on Chinese growth, because you had this booming economy over in China. They were building everywhere and everything all at once, really. And so you had this huge demand for steel and these base metals that, now that we've seen China's economy kind of flounder to some extent, that demand is not there anymore. They've really pulled back on commercial real estate investment, on residential real estate development. So you're just not seeing as much base metal usage as you used to. So at least if we're talking about steel, I'd say the outlook still isn't great going into 2025. But you are seeing, I think, at least in the US, domestic industrial production increase to some extent. So that should offset that Chinese weakness. But it's really hard to see significant growth if China's kind of left out of that picture.
And on the same track, you have, copper, lithium, materials like that also suffer from the, global macro of China weakness. Those both big inputs into electrification, into, whether it's EVs or copper, especially into data centers and the build out of the power grid. So you have some additional vectors there, but still being kind of in the short term, at least, kind of very hampered by China weakness. And then something else I want to point out that makes the material sector so interesting sometimes is that for steel, copper, lithium, these are very global markets where you're really worried about China, about India, your major players and consumers of these. But then you also have things like those rock aggregates that, because there's not a whole lot of value add, you can kind of find, well, there's value add, but you can find rock pretty much anywhere that you can turn into rock aggregate for construction. This is very regionalized. It's very expensive to ship. So you're not going to be shipping gravel intercontinentally. You're just going to be, using it where you're producing it. So some businesses like that are more regionalized can do well, while other materials that are, more hamstrung by geopolitics and global macro conditions, don't do so well.
Yeah, and I think that's an excellent point because that's not just true on an international level, it's true on the national level. I mean, we've looked at aggregates companies within Texas, for example, where the Texas economy has been booming. A lot of the Sun Belt region has been seen a lot of growth in recent years and continues to grow significantly. So the those aggregate producers that are within this region have outperformed those, say, in the Northeast, just because you have better growth here in the Sun Belt area. So I think to your point, it's really interesting. So shifting from base metals, I think it's interesting to get into something a little bit more consumer focused, and that is airlines. Earlier, we mentioned aerospace and defense with respect to those defense contractors, but airlines are companies that forever have really struggled to find consistent profitability. I wouldn't say that they're necessarily out of the woods in that regard, but it does seem like airlines have found the sweet spot of how many flights am I going to provide versus what is the demand. And they're being a little bit more conservative in that regard, which is helping their business. We've seen, especially in the last 6 months, airlines have performed extremely well. Now, a function of that has been the revenge travel coming out of COVID, but it seems that we're getting into a more normalized supply demand market as far as flights go, and people are kind of just traveling normally now. And I think it's interesting seeing how airlines have performed pretty well and continue to perform well because they're not over allocating flights. They're not offering too many flights where they're losing out on the profitability side. So they're kind of finally finding that sweet spot as far as whether or not they can actually make some money.
Yeah, I think COVID forced a lot of these companies to, really, really pull back and reevaluate where they're flying and why. Focus on your profitable lines, focus where people, really are, and pay less attention to being one company that can get you anywhere in the country or globally you need to go. Focus on where you're good and what you can do well. So I think coming out of COVID, you have that revenge travel, which most indications seemed like that was pretty much winding down. So to see the last 6 months, especially in these companies be so positive is really encouraging. Finally, on that, something that we need to pay attention to is that the market for airplanes has been really tight. I mentioned Boeing earlier. They're always a tough one because they've been going through issues for a long time now. And, they're one of the biggest airplane manufacturers in the world. You have Airbus, who has had their own, share of issues, not big ones, but they can't deliver all the planes that they had, as well as the ones that Boeing can't. And then you have, some smaller airplane producers, such as like Embraer, who are really rising up through the ranks because Boeing has left such a hole in the market. So, it's something that will be interesting to watch because you have like all of this supply that kind of has dried up recently.
I think it's really interesting seeing those airplane manufacturers because tracking them quarter over quarter, it seems like their backlog only continues to grow. And now it's like, okay, if I order an airplane now, it's going to get delivered in 2030 plus. I mean, it's a pretty wild environment for these airlines to try to decide, hey, when am I actually going to be able to get new airplanes? And that's probably why, if you've been on some flights recently, every once in a while, you'll hop on a plane it's pretty old. I mean, you're seeing planes get retrofitted. They're kind of upgrading the internals to some extent, but a lot of these planes have been around for even decades at this point. And so it'll be interesting to see if those airplane production companies like Boeing, like Airbus, can actually ramp up production to the extent that these airlines demand it. Because I know we'd all like to see increased flights. That means cheaper prices for consumers, but that's just a really interesting dynamic about the industry.
Yeah. And then one other thing that's been really helping airlines recently, so part of that last 6 months outperformance, is the price of oil. Jet fuel is so much cheaper right now than it has been over the past few years. I mean, we've really recently come out of super high oil prices. And so now that's trickled down into those refined products such as jet fuel. So they're really getting a good cost savings on that front as well.
Absolutely. And I think if you look at where the risks are to energy prices in the medium term, they're risks to the downside rather than the upside, which has to make you feel pretty good as an airline because you're thinking, hey, if something goes wrong, it probably means that oil is cheaper, not more expensive. So that obviously bodes well for their profitability and for us as consumers as far as ticket prices go. Now, I think one final trend that we should really talk about in this podcast is the reshoring of supply chains back to the United States. This is a big initiative of the new administration in office in Washington. And I think as far as industrial production, it's really important because you're seeing more supply chains getting relocated here. That means more spending on that manufacturing footprint, but also on those aggregates, those materials that go into production. And so it creates a really interesting dynamic for companies here within the United States. A lot of that has already shifted outside of countries like China, towards more neighboring countries like Canada and Mexico, but even more so, it looks like moving forward, that's going to get relocated to the United States. So seeing those dynamics when it comes to the industrial sector, the material sector should be really interesting.
Yeah. And it is interesting because you have everything from, your steel, like we saw US Steel in their current situation trying to get bought by a foreign company, and neither administration liking it. No one's really taking Nippon's side and trying to get that deal pushed through because US Steel is US Steel, even though they're not the largest steel producer in the US by a long shot. It's called US Steel. And when you're trying to get things moved here, it's not great look for things to be getting bought by outside investors. But that from steel all the way up the, value chain, if you will, to things like chips with all of the new fabs being built in Arizona and Texas. It's a really, really interesting trend to keep watching.
Yeah, absolutely. I think you're certainly seeing, just as we talk about this podcast as a whole, kind of revolutionizing of these old industries, of the industrial segment, of materials. You're becoming higher tech. It's requiring new infrastructure. So I think the building out of that, especially when it comes to reshoring that to the United States, is going to be really interesting, something for us to track as we move into 2025.
Yeah, well, I think we've hit all the major industries within the two sectors we decided to tackle today. But, as usual, if our viewers have anything else they'd like us to expand on more, I invite them to leave us a comment. But short of that, Victor, thank you very much.
Thanks, Hunter.